Alright, guys, good morning. So, let's talk about chapter 9 today, investment property. And I know that you have already have an idea of what is an investment property is with your other accounting subject. But let's talk about the perspective in the side of the government. But if we take a look at page 220, we're still seeing the same definition. Investment property is a land or a building held for rentals or for capital appreciation. So it is not held for use in the production or supply of goods or services for administrative purposes or sale in the ordinary course of business. Again, the purpose of investment property is for rentals and capital appreciation. So we have um, the following list of investment property. So you just have to take a look at this one. Land held for capital appreciation rather than for short-term sale in the ordinary course of operation. Land held for currently undetermined future use. We also have here a building owned by the entity and lease out under one or more operating leases on commercial basis and so on and so forth. So basically, these six are the major category of examples of investment property. And if you take a look, or if you have seen for letter C, we are talking about operating leases. So we have two types of leases. We have operating and finance lease. And I just want to differentiate this one just to reinforce your knowledge about this. If we talk about operating leases, this is where we do have a lessee and a lessor relationship, but at the end of the term or at the end of the contract, the lessor will still be the owner of the property, meaning to say the one who rented out the property, or the original owner of the property will still be the owner at the end of the contract or the term. On the other side of the coin, if we're talking about finance lease, at the end of the term, the lessee will become the owner of the property. So just want to talk about that, just to reinforce your knowledge about finance and operating lease, the difference between the two. So basically, those are the six major examples of investment property. On the next page, we have the following list of the items that are not considered as investment property. Again, if we talk about investment property, this is held for rentals and for capital appreciation. So the rest, those items or those property that will fall out with that definition, it will not be classified as investment property. So we have the biological assets related to agricultural activity, as what we've discussed in the previous chapter. Mineral rights and mineral reserves such as oil, natural gas, and similar non-regenerative resources. So we also have here property held for ordinary course of business. As mentioned, it is not part of investment property. Another one is property being constructed or developed on behalf of third parties. Owner-occupied property, property that is leased to another entity under a finance lease. Again, sample of investment property is a lessee contract, a lease contract, I mean, that is under operating. So, if you talk about finance, it's not part of investment property. Property held to provide social service and which also generates cash inflows. Property held for strategic purposes and property held for use in the production or supply of goods or services. So basically, those are based on the standard, the items that is not considered as investment property, and other similar properties that will fall under these items. So how are we going to measure investment property? So initially, it will be measured at cost. So at cost, the measurement of cost depends on the mode of acquisitions, because we do have different type of acquisitions. So let's talk about cash purchase. So the cost of investment property acquired through cash purchase comprises the purchase price and any direct cost necessary in bringing the assets to its intended use, just like professional fees for legal services and property transfer taxes. So that is for our um, cash purchase. So let's move to the next mode of acquisition. Let me grab my notes. So we have But let's have an example first. So entity A purchases land to be held for capital appreciation for 1,000. Again, for 1 million, entity A pays 80,000 for legal services and transfer taxes related to the acquisition. Again, it was mentioned that the purchase price comprise as well those direct costs that is needed for the item or for the asset to be bring to its intended use. So that's why if you take a look in the entry, we included the legal services. So investment property land debit 1,080,000, and then the credit is cash modified disbursement system regular. So to recognize the purchase of investment. So that is for cash purchase. Next is for installment purchase. We know that installment purchase, it will be on periodic basis. We have to pay some sum of money. It depends on the contract. So the cost of investment property acquired through installment purchase is the cash price equivalent. The difference between this amount and the total payments is recognized as interest expense over the period of credit. So the total, the cost of the investment is the cash price equivalent, and the difference between that amount and the total payment, it will be part of the interest expense. Next is the non-exchange transaction. The cost of an investment property acquired through a non-exchange transaction is the fair value at the acquisition date. So example, entity A receives an unconditional donation of land with a fair value of 1 million. So there is a transfer of land. So basically, we will be talking about the land. So the debit on that is investment property land 1 million, because that is the fair value of the property we received. Credit income from generation, from grants and donations in kind. Next is self-construction. Construction, I mean. So we constructed, that's why the cost of self-constructed investment property includes the cost of direct materials, labor, and overhead. So basically, those are the manufacturing costs. The cost of wasted materials, labor, and other resources incurred in constructing the property are recognized as expense or expense outright. Construction costs incurred are initially recorded in the CIP or construction in progress account pending the completion of the investment property. But upon completion, the construction costs are reclassified, to the investment property account. Okay? So the cost of investment property does not include the following. So first, startup costs unless they are necessary to bring the property to the condition necessary for it to be capable of operating in the manner intended by management. Basta all other costs that is not needed for the property to be placed in its condition for us to be able to use it based on its purpose. So it will be part of startup cost, and it will not be part of the investment property. Another one is operating losses incurred before the investment property achieves the planned level of occupancy or the normal capacity. Abnormal amounts of wasted materials, labor, other property resources mentioned earlier, it will be an expense outright. Okay, so let's discuss subsequent measurement. Investment properties are subsequently measured under the cost model. But previously, as mentioned initially, it will be based on the cost model at cost, but it depends on the model of acquisition. But if we talk about subsequent measurement, it will be via the cost model. Under this model, the investment properties are measured at cost less any accumulated depreciation and accumulated impairment losses. The fair value model, which is available to business entities, is not allowed for government entities. So take note, for business entities, we are allowed we're allowed to use the fair value model. But for government entities, we are going to be using only the cost model. So just take note from that. Okay? So that's how we're going to be measuring investment property subsequently. Okay. So let's talk about transfers to or from investment properties. So basically, there's still, just like with the business entities, there's still this concept wherein, for government, I mean, wherein we can still transfer a property, like for example, held for, held for production, and it eventually it will be transferred to investment property. That's applicable, and vice versa. So transfers to or from investment property shall be made only when there is a change in use, as evidenced by the following. So basically, that is the requirement. There is a change in use, and the following evidences is present. Commencement of owner occupation for transfer from investment property to owner occupied property, and of owner occupation for a transfer from owner occupied property to investment property, so vice versa. Commencement of an operating lease to another party for a transfer from inventories to investment property. So inventory, basically it is for ordinary course of business. And commencement of development with a view to sale for a transfer from investment property to inventories. So basically, it will be out from investment property because it will be part of the ordinary course of the business. So those are, but again, we should be having this concept, or we should be accepting this concept, transfer to or from investment property, if there is really a change in use and the following evidence is present. I'm not saying all, because A, B, C, D are independent cases. Okay, so just take note of that. And again, in government entities, we are not allowed to use the fair value model for subsequent measurement. We are gonna be using only the cost model. A government entity accounts for transfers to or from investment property at cost. Accordingly, no gain or loss shall arise from the transfer except when the transferred asset is impaired. Again, there is no gain or losses shall arise from the transfer. But there is an exception where the transferred asset is impaired, in which case impairment loss shall be recognized first before making the reclassification. So we will adjust the amount. We will be recognizing the impairment loss, and after recognizing that one, the new carrying amount, that will be the carrying amount for the property that will be reclassified. Okay? So clear.